You clicked this video because you're tired of watching a massive chunk of your hard-earned income vanish into a tax black hole while you're busy building a borderless life. You want to keep what you earn, and you want to do it without crossing any lawful boundaries. Welcome to the invisible architecture of global wealth. By the time the screen fades to black, you'll understand the exact mechanics used by the global elite to reduce their tax obligations to absolute zero. This isn't about hiding cash in offshore briefcases or dodging the law. This is about structural leverage. We're going to break down the global tax code into 5 actionable modules. First, we'll dismantle the concept of territorial taxation and show you how geography dictates your wealth. Second, we'll decode the ultimate expatriate loophole, allowing you to shield well over $100,000 of earned income from your home government. Third, we'll introduce the corporate layer to separate your personal identity from your business revenue. Fourth, we'll explore how real estate investment trusts function across borders to give you tangible assets without the local tax burden. Fifth, we'll navigate the uncharted waters of decentralized finance and how staking digital assets alters your territorial footprint. Get ready to shift your paradigm. Forget what you know about owing the government just because you hold a passport. The map is drawn with distinct lines when you change your perspective. Most people are born into a worldwide taxation system. If you belong to countries that use this model, the government tracks your income across the globe. It doesn't matter if you make money in Tokyo, London, or Buenos Aires. Your home nation demands its cut. A select group of nations operates on a territorial tax system. This means they only tax income generated within their physical borders. Imagine you're a software developer, setting up a home base in Panama or Paraguay. You register as a resident. Your clients are based in Europe and North America. Because your revenue originates outside of your new home country, your local tax obligation on that foreign-sourced income is 0%. You're permitted to keep every single cent of that revenue. Other nations like Costa Rica and the United Arab Emirates offer similar territorial or zero-tax frameworks for digital nomads. The United Arab Emirates, placing a spotlight on Dubai, has become a magnet for international founders because it lacks personal income tax on foreign revenue, provided you establish genuine substance and don't treat it as a mere paper residency. A territorial system isn't a magic wand. You must sever your primary tax residency from your home country. For many global citizens, this requires a clean break, proving you no longer have substantial ties to your former residence. You must track your days with absolute precision. A single miscalculation in your day count can drag you back into the tax net of your home country. Some nations require you to avoid returning for more than a few weeks per year. This is the foundation of digital nomad wealth, aligning your physical location with a jurisdiction that respects borderless income. You become a ghost to the high tax regimes and a welcomed guest in nations that reward your mobility. What if your home country refuses to let you go? If you hold a passport that demands worldwide taxation, you need a different shield. Let's address the elephant in the room for certain passport holders who are taxed on global income, regardless of where they live. You can't move to Panama and ignore your tax returns. There's a lawful mechanism designed to protect you, the Foreign Earned Income Exclusion. Think of this exclusion as an impenetrable force field around your primary salary. Imagine making $100,000 while designing architecture in Dubai. Instead of paying a heavy toll to your home government, you apply this exclusion. For the tax year 2026, the tax authorities allow qualifying individuals to exclude up to $132,900 of foreign earned income from federal income tax. If you're married and both partners qualify, you can double that protection to well over $260,000. To activate this force field, you can't take a short vacation. You must pass one of 2 rigorous tests. The first is the physical presence test, which mandates that you spend 330 full days outside your home country in any 12-month period. The second is the bona fide residence test, requiring you to establish a permanent tax home in a foreign country for an uninterrupted tax year. This exclusion only applies to earned income. It shields your salary, wages, and professional fees. It doesn't cover passive income like dividends, capital gains, or rental profits. If you try to claim passive investment returns under this exclusion, you'll face severe penalties. This mechanism requires strict compliance. You must file the proper forms, such as Form 2555, every single year, even if your total tax owed drops to zero. For those maximizing their wealth, you can combine this with the foreign housing exclusion to deduct excess rent paid abroad. By mastering this rule, you neutralize the penalty of holding a restrictive passport. Operating as a sole proprietor is the fastest way to hit a wealth ceiling. To scale your tax strategy, you must separate yourself from your business. When you're a freelancer or a solo consultant, the money you make is tied to your personal identity. This makes it difficult to control when and how you're taxed. The solution is creating a corporate shield. By establishing a business entity in a zero-tax or low-tax jurisdiction, you dictate the flow of capital. Imagine you run an online marketing agency generating $500,000 a year in profit. If you run this through a bank account in a high-tax country, you face massive corporate taxes before you even pay yourself a salary. Instead, picture setting up a limited liability company in a jurisdiction like the British Virgin Islands, Wyoming, or a free zone in the United Arab Emirates. The business earns the revenue, not you. The corporate entity holds the capital, pays the operational expenses, and reinvests the profits into future growth without instant tax friction. You only pay personal tax when the company distributes dividends or pays you a salary. If you followed the steps from Module 1 and established your personal tax residency in a territorial tax country like Paraguay, those foreign dividends from your offshore company arrive in your personal account without taxation. This is the ultimate synergy. The offshore company acts as a dam, holding your wealth in a tax-neutral environment. You control the floodgates. When you need living expenses, you distribute just enough capital to fund your digital nomad lifestyle. The rest of the money stays within the corporate wrapper, compounding year after year. You must navigate controlled foreign corporation rules if your home country demands worldwide taxation. Some nations will look through your offshore company and tax you as if you earned the money personally. Pairing an offshore entity with a lawful expatriate exclusion or a pure territorial residency is mandatory for the strategy to hold weight. Shielding your active income is just the beginning. The real game is multiplying that wealth through real estate without triggering massive local tax bills. When you start saving $100,000 a year in taxes, you need a place to park that capital. Buying physical property abroad sounds romantic, but it creates a complex web of property taxes, maintenance costs, and potential local tax liabilities. The solution is the Real Estate Investment Trust. Translate this into a real-world scenario. Picture yourself sitting in a cafe in Lisbon. You want to invest in a massive commercial office tower in Manhattan, a logistics hub in Madrid, or a luxury apartment complex in Dubai. Instead of buying a building, you buy shares in a trust that owns and manages these properties. You get the benefits of rental income and property appreciation without ever dealing with tenants. From a tax perspective, these trusts are powerful tools. In places like the United Arab Emirates, certain trusts are exempt from corporate income tax if they meet distinct criteria, such as having a significant asset value and a percentage of shares traded on a recognized exchange. In Spain, similar structures exist to channel capital while offering unique tax advantages for non-resident investors. Here's the critical strategy for a digital nomad. If you reside in a territorial tax country, the dividends you receive from a foreign trust are classified as foreign-sourced passive income. Territorial countries don't tax foreign-sourced income. You can earn substantial dividend yields from global real estate markets and bring that cash into your host country with a 0% tax rate. You're using the trust to bypass the friction of direct ownership, and you're using your territorial residency to bypass the taxation on the dividends. It's a dual-layered wealth optimization strategy that turns global bricks and mortar into liquid, tax-free cash flow. The traditional financial system is slow and it's tied to geography. But what happens when your assets exist nowhere and everywhere at the exact same time? Welcome to decentralized finance, the ultimate borderless economy. As a modern investor, you're likely holding digital assets. You aren't just holding them, you're staking them, lending them, and providing liquidity to automated market makers. Imagine placing your digital tokens into a virtual vault that acts like a global, borderless bank account. You provide liquidity to a network, and in return, the protocol rewards you with more tokens. This is yield farming and staking. But how do governments tax an asset that lives on a blockchain? Tax authorities view cryptocurrency as property, and every disposal or swap is treated as a taxable event. When you receive staking rewards or interest from a decentralized lending protocol, it's classified as ordinary income calculated at the fair market value upon receipt. If you swap one token for another, you trigger capital gains tax based on the price difference. This is where the digital nomad strategy reaches its pinnacle. If you're sitting in a country with a worldwide tax system, every time a smart contract deposits a microfraction of a token into your wallet, you owe income tax. It becomes an accounting nightmare. But if you've transitioned your tax residency to a zero tax or pure territorial jurisdiction, the game changes. Because decentralized protocols have no physical headquarters, the income they generate is inherently foreign to your territorial host country. By structuring your wallets and holding companies with intent, the yield you generate from staking and lending remains outside the local tax net. Even countries attempting to regulate this space struggle to apply traditional financial frameworks to decentralized entities. Regulatory bodies are pushing for new reporting standards and tracking methods to capture this decentralized revenue, meaning you must stay vigilant. By maintaining absolute compliance with your host country and structuring your digital portfolio as a non-resident asset base, you create a lawful, zero-tax environment for compounding your digital wealth. You transcend borders and operate in a parallel financial universe. Mastering your physical location and understanding the difference between earned and passive income are the keys to unlocking true financial freedom. You have the blueprint to optimize your wealth, shield your assets, and build a life without borders. But keeping your money safe from taxes is only half the equation. You also need to stop bleeding cash on exorbitant banking fees while traveling the globe. To discover the exact tool that eliminates foreign transaction fees and gives you premium travel perks without the ridiculous upfront cost, click the video on your screen right now for the $0 annual fee card that beats the premium giants, and I'll see you over there.